Hello everyone, welcome back to another video from Personal Finance for Us, and today we're going to be talking about something that is very important but often misunderstood, and that is 401k plans. Now, it's a really important account. It can be vital for wealth building and for your retirement plans, so it's important to really understand how to use them and how they function. So let's just start with the basics. First, what is a 401k? 401k is really just named after where it is in the tax code. Its cousin, the 403b, is a non-profit version of the 401k, but effectively they have the same function. I've worked for a couple of hospitals that I've worked for because they were not-profit or business listed as not-profit. We had 403b plans instead of 401k plans, but effectively they serve the exact same function. 401k plans are employer-sponsored plans. This is an important thing to keep in mind and to understand, because it's unlikely that you're going to be with the same employer from the time that you are 20 to the time that you can withdraw at 59 and a half. This account can only be funded with pre-tax dollars from your employer that's sponsoring the program. So if you have a side hustle or a second job, you can't take money that you've earned from that job and put it into your employer 401k plan. It doesn't work like that. This is pre-tax dollars from the sponsoring employer. Now, a 401k is just a type of account. It's the house that your money sits in, and this house is how it's treated in section 401k of the tax code, right? So you'll contribute, you'll put the money into the house, and then with that money you will buy investments that get treated in a certain way as long as they are in that house. You'll hear a lot of people talk about the 401k as if it is the investment. It's just a house. You buy the investments. Most frequently, the number one investment you're going to be able to purchase in a 401k, more often than not, is going to be what's known as a mutual fund. Now, for the purposes of this video, we'll give mutual funds their whole other video down the line. But for mutual funds, it's basically like buying many different stocks wrapped up in one fund. So that way, instead of you trying to handpick a bunch of individual stocks, mutual funds kind of do it for you, and subsequently will kind of diversify your risk. So you'll have money in all sorts of different sectors. On that note, it's a good idea when you first open your 401k is to go and look at what sort of account, a lot of times, or what sort of fund I should say. A lot of times you'll automatically be placed in a fund, but it may not be the best performing fund depending on your goals and your age and all of that sort of thing. So it's a good idea to look at what you're automatically investing in and look at that fund's track record over the years. Consider how much time you have before retirement. You may want to go in there and make some changes from just the standard. So it is something that you're going to want to read about and pay a little bit more attention to. It's also important to know the rules of the 401k. Because they are special tax sheltered accounts, you can get yourself into financial trouble if you don't know the rules and you break them. Now, 401k plans are funded with pre-tax dollars. This is a good thing because that means a little more money is allowed to go into the account and to grow. Now, you have to keep that in mind, because if at any point you withdraw any of that money, whether it's early or at age 59 and a half, you will have to pay taxes on it. Also, employers often do what's called a 401k match. So this is another awesome thing about this type of investment account. Many times you'll see a 3% match. What that means is if you put in 3%, your employer will put in 3%. This is effectively free money. And it actually blows my mind that sometimes, a lot of times, people actually ignore this free money and don't put any money into their 401ks. Okay, so let's look at this. Say you make $50,000 a year and you're putting up to the match, which is that 3%. 3% of $50,000 is $1,500. So that's $1,500 a year that you're putting towards your retirement. If your employer offers a 3% match, that is effectively doubling your retirement account. So let's take a look and see exactly what that will equate to. Okay, so we've busted out our handy dandy investment calculator and we put in the following. So let's assume you're 25 years old, you're going to be working for the next 35 years. Stock market average rate of return is about 7.5%. And let's assume there is no employer match, but we're putting in 3% of $50,000 over that 35 years. We're going to put in $52,500. The investment is going to make about $178,800 for a total balance of $231,000. Not too shabby. Now, I once had a friend scoff at a 3% match, but let's take a look. Running this same scenario, doubling the annual contribution, so if that contribution is doubled, that brings our annual contribution from $1,500 to $3,000. And now the total contributions is $105,000 with a gain of $357,000 for an ending balance of $462,000. That is a huge, huge difference. And the best part is, we still only put in the $52,500. Our employer did the rest, but look at the difference in the interest gained over time. So if your company offers a match, it's kind of a big deal and you should absolutely take it. Now there is one thing to keep in mind. Even with free money, there's still no such thing as a free lunch, ever. So a lot of times you may have to be what's called vested, and all that simply is typically your employers want you to be with them for a certain amount of time. So you'll get the match, and when you look at your statement, you'll see the vested balance and you might see a non-vested balance. Basically what that means is, say they give you a match from day one, and say the company wants you to be vested for 3 years. The match will go into your account and it will grow, but you cannot take that money with you if you leave in under the 3 years. So some companies, it might be 3 years, some might be 5 years, but the money you put in is yours, but the match amount that they put in, they will take back if you don't stay to the vested period. And this is just so they get a little bit more time out of you. It's just an incentive to stay. Other times, employers may not do a match right away. You may have to work for the company for a year, and then they'll start your match. So again, it's all just kind of a way to get you to stick around a little bit longer. After that vested period, the money is yours, so you can take it and roll it into your next 401k or whatever. The next rule to keep in mind is that there are contribution limits, and that's with all retirement accounts. The government doesn't want you to try to go ahead and stuff all of your paycheck into a 401k account to try to get rich and not pay taxes. They don't let you do that. That being said, for the average working class person, these contribution limits are pretty high. For this year, 2020, the contribution limits are up to, I think, $19,500. So if you're a very high income earner, you could actually potentially max this out and delay your tax pay. The most important thing to understand when dealing with 401ks is the withdrawal rules. I casually mentioned earlier that the withdrawal age of these accounts is 59 and a half years old. From that age, you can withdraw without penalty. Any withdrawals made before that age, you will get penalized. It is imperative that you treat the 401k as it is a retirement account. It's not a savings account, so you need to treat it as such. As we talked about earlier, no matter when you withdraw this money, you will have to pay taxes on it, so you don't want to add a 10% penalty on top of having to pay taxes. On top of that, now you've removed that principal, so that principal is no longer growing. You're not getting the compound of that growth. You're paying taxes and you're paying a 10% penalty on top of it. It's just a really negative financial consequence to pull that money out. So, if at all costs, try absolutely your best to never do it. Now that being said, there's only 5 instances in which you can withdraw from your 401k anyway. The first we talked about is being age 59 and a half. The second is death or disability, but obviously death. The third is when you leave the job. The fourth is if you experience a hardship as defined by your plan. And the fifth is if your employer terminates the plan. So yes, technically you can withdraw the money when you leave the employer, but again, this is going to trigger an undesirable tax event. Now you can borrow from your 401k, and unfortunately, this is a commonly practiced thing. Financially speaking, it's really not the best decision. If your plan allows it, you can borrow up to 50% of the vested balance, up to $50,000. The loan must be paid back in 5 years, the exception being if you've used it as a down payment for a home. There is interest, but you are paying yourself, which is often the rationale people use for actually borrowing the money from themselves in the first place. It's still not particularly advisable, even if you are paying yourself interest, because you've pulled that money out of the market. So if the market has its best bull run ever and you've pulled this money out, you've missed it. There's another important caveat to consider, which is why I don't like the idea of borrowing from 401k, and that is, again, 401ks are employer sponsored. So if you pull that money out and something happens with your employment, guess what? You're on the hook. So let's run through a scenario. Let's say you've taken out a loan for your 401k to purchase a car. Let's say you're 3 years in, you're driving a car, so of course it's depreciating in value, and you have some sort of incident that causes you to lose your job. Whether that be your fault, an accident, things happen, we're human, something like COVID happens and companies end up having to cut lots of jobs, some major incident, things in this life do happen, right? So if something happens that causes you to lose your job, and now you have 2 years worth of this loan left to pay. When this happens, the loan turns into a withdrawal, and now you've created a tax event. So now you're paying taxes, you're paying a 10% penalty, and this is all for an asset that lost value as soon as you drove it off the lot. Be very, very thoughtful if you are considering borrowing from your 401k. I generally don't recommend it. Okay, the last thing to understand in regards to the 401k is the rollover. So as we mentioned earlier, leaving your employer is a situation in which you can withdraw money, but better than withdrawing money is to do a rollover. There's 2 ways to do this rollover. What a rollover is basically just taking the money from one retirement account and putting it into another retirement account. That practice is called a rollover. So there's 2 ways to do that. There's the way you want to do it, which is the direct, which means you go from employer A's 401k to employer B's 401k. You never touch the money. It just goes from account to account and you keep going. The second way is an indirect, and that's when the first brokerage writes the check to you, and then you take the check and put it to the next company 401k. That triggers a tax event. We don't want to do that. Now, one cool thing about the 401k rollover allowances is you can move the money to any type of retirement account. So again, you can go from company's 401k to company's 401k, or you can roll it into an IRA. Now, I've intentionally avoided getting too much into IRAs because this is a 401k video, but we'll definitely get into IRAs as they are very important at a later date. But that's just something to keep in mind, that you can move money from a 401k to an IRA. Okay, so really what we've been talking about is the traditional 401k. However, there are other types. It's not super important for you to know because it's really chosen by the employer, so you don't have any control over it. But just in case you do see it, just so you know what they are, the one exception is the Roth 401k. That's the one that's going to make the biggest difference for you as an employee. Okay, so those 401k types are the Safe Harbor 401k. This is a pretty popular plan among small businesses. It's advantageous for both you and them because one, part of the plan is they have to give everyone at least a 3% match. But two, because they do this, it gives them a little bit less administrative work to have to take care of as a smaller business. So smaller businesses may use a Safe Harbor 401k. A simple 401k is a plan that really small businesses might use. The cutoff is 100 employees, so if you have fewer than 100 employees, if you're working for a tiny company, a tiny startup or something like that, you may run into the simple 401k. The next one will be a solo 401k. As is indicated in the name, solo, this is for someone that is a solopreneur that doesn't have any employees. Okay, now the last of these is the Roth 401k, which is pretty much like a combination of the Roth IRA with the 401k. So it's pretty neat. It's rare, but it is growing in popularity. So what that is it's different from every other 401k in that you do fund it with after-tax dollars, much like a Roth IRA. However, it still has a traditional IRA's contribution limit. So for anyone that doesn't know, if you went on, pick a brokerage, Fidelity, Vanguard, whoever, opened up an IRA to start putting extra money into your own retirement, you would be capped at $6,000 a year. Contrast this with the Roth 401k, and you can actually invest the full $19,500 like a traditional IRA per year. But you still get the advantage, since it is after-tax dollars, of that money growing tax-free. So if you are one of the rare people who works for a company that offers this, absolutely take advantage of it. Alright everybody, that'll do it for this video. I hope you guys found it helpful. I hope it was clear as always. Again, this has been Personal Finance for Us. We out. Peace.